Our next session is on virtual finance, inclusive, invisible, impactful, and the moderator, Deputy Chairperson of the International Integrated Reporting Council, over to Jain Diplock.
Thank you very much. Ladies and gentlemen, when Manjeet Kriplani asked me to moderate this session, I have to say I took a deep breath, and I said to her, I'd absolutely love to, because it's a subject that fascinates me, but I know too little about it. How fortunate, then, am I to have two such distinguished speakers to try to assist us to make some sense of virtual finance. As Elvira has said, inclusive, invisible, impactful, and one might add, impenetrable. But the panelists this afternoon who are going to help us penetrate this difficult subject are Anshu Jain, former CEO of Deutsche Bank and advisor to SoFi, and Piyush Gupta, Group CEO of DBS Bank Singapore. Both of them, I have no doubt, are going to be great guides through the impenetrable forest of virtual finance. Allow me to set the scene for our discussion. 2008 was different. The global network of financial infrastructure suffered a near-death experience. And the blow to global financial capital can be measured. At their peak, the world's 100 largest banks had a market cap of about $4.9 trillion, about 8.5% of annual global GDP. At its trough, that had fallen to 1.4 trillion, a destruction of capital of 3.5 trillion. These are the Bank of England's figures. And there's been some recovery, but the market capitalization of the 20 largest banks today remain at about half of their value in 2007. And these losses pale when compared to the wider economy. For advanced economies, cumulative losses stand around $32 trillion. These are incredible numbers, and these losses are unlikely to be fully recovered, certainly not in the short term. And the confidence in the financial markets will also be difficult to recover, as we discussed this morning. So when we look around the world today, in 2016, the capital markets are changing shape as we watch. Where is capital being raised today? Certainly, some is being raised in IPOs on regulated markets, often with dual-class shares. The pipeline of IPOs in China remains robust, and market activity in this country is strong. But many other markets are not so fortunate. There seems to be a move towards alternative methods of financial capital raising. Private equity, private holdings, peer-to-peer lending, crowdsourced funding, some of it which is regulated in some markets. As I was driving in from London, Heathrow Airport in London, in a black cab the other day, I saw a brewery truck, and it said, "Invest in our home brewery, regulated by the FCA," which I thought was rather remarkable. And I thought I'd share with you some headlines. On May 17th, 2016, there's a headline that cryptocurrency exchange Gatcoin was hacked last week and lost 15% of its assets. The company lost 185,000 Ether shares, whatever they are, and 250 Bitcoins, with a combined value of $2 million, according to a report by Silicon Angel. On May 31st, 2016, the US Postal Service has partnered with Swiss Economics to look into possible uses of the blockchain technology for its services. The US Postal Service has released a report examining the potential applications of the technology to its business processes, according to an announcement. On June the 9th, 2016, the Central Bank of the Philippines is considering the regulation of Bitcoin exchanges as part of an effort to fight money laundering. The bank is also looking at cracking down on remittances after Philrem Service Corp transferred money stolen from the Bangladesh Central Bank by hackers, according to a report by South China Morning Post. On June the 10th, 2016, Indonesian-based payments platform Kinerjapay Corp has partnered with Bitcoin Indonesia to facilitate Bitcoin payments on its platform. Kinerjapay will become the first e-commerce portal in the country to accept Bitcoin, according to the press release. So as Goldman Sachs patented Settlecoin, a cryptocurrency settlement system which offers a near-instant settlement system for trades, including stocks and bonds, and I quote, without the risks inherent in traditional settlement systems. As the Bank of England ventures into the crypto-technological sphere itself with RS Coin and the development of regulated mintets, has Monty Python been involved here? I can't believe that mintets are small mints, but perhaps. And the chief economist of the Bank of England suggests banning cash. I'm not making any of this up. And the People's Bank of China announces it will set up its own virtual currency that will commence in a few years. What exactly is happening in this world of virtual finance? Ladies and gentlemen, I'm going to ask Jain to start our discussion this afternoon, hopefully drawing some of the veils off this impenetrable subject and giving us a chance to converse with him about what he thinks the world of virtual finance will look like in the future and how we get from here to there. Thank you, Anish.
Thanks, Jain. So I think the best place for me to start would be to provide the backdrop in which virtual finance has thrived by talking a bit about what's happened to traditional finance over the course of the last 8 years. Because I think the two topics are intimately related. There's a lot of discussion around disruption and so on and so forth. I think too much is made of that. But there are some very powerful undercurrents which have created the circumstances where the topic today is more important than ever before. And the underlying themes for me really are three in particular. The shape of bank regulation, as you would expect post-2008, is fundamentally different. Society wants banks to look very different today than it allowed them to be pre-Lehman Brothers. And that change has been fundamental and profound. Business practice has been cut dramatically. Banks are simply not allowed to be principal investors anymore. They're not allowed to do private equity. So certain things are gone by fiat. In some countries, there's ring fencing between retail operations and wholesale operations. Everywhere, there's a universal view that if you take deposits, you could impose a very significant societal risk and hence have to be looked at very differently. Clearly, the amount of capital which you have to hold has gone up dramatically. Liquidity needs are now specified to very strict standards, and in fact, term funding is critical. I can carry on, but the bottom line is the banking industry itself looks very different today than it did 8 years ago. The second theme, which I think is starting to acquire the prominence that it's actually deserved all along, is the entire theme of negative interest rates, or very low interest rates, depending on the country, and how significant that is. And for the audience in India, where rates are still running in the high single digits, it would be interesting to note that more than half the world's sovereign debt outside India is now zero or negative yield. That's a fundamental, profound, sweeping change, and in some ways perhaps even more important than the changing face of regulation, because the way insurance companies work, the way pension funds work, the notion that $1 a year from now is worth more than $1 today. Or I could borrow money from you and wind up having you pay me because I've been good enough to borrow that money from you, destroys modern finance the way we know it. NPV calculations go out the window. And of course, it's having a fundamental impact, once again, on banks and deposit-taking institutions. Third one, of course, is technology, which has moved all along very rapidly, but certainly in the last 8 years, the cost of storage, speed of computation, big data, proliferation of smartphones, now becoming a ubiquitous branch, again, fundamentally transforms the landscape. So these are the underlying themes. And I think what's come from it, if I draw a straight line between 2008 and now here we are in 2016, I think the risk assets which were controlled predominantly by banks have shrunk. Big banks of the world today are anywhere between 30 to 50% smaller than they were. And of course, there's been almost a direct transfer out of the banking system into so-called shadow banking. So when we talk about virtual finance, to me, the biggest player of all, fintech is still, which I'll talk about in a minute, burgeoning. The really big growth that we've seen has been in the private equity, hedge fund, and increasingly the ETF industry. So instead of money being kept in overnight deposits or certificates of deposit and then transformed by banks into lending, which is the traditional form of capital formation that we've known, now we've seen a outsourcing away from the banking sector directly into asset managers, ETFs, or hedge funds, and they're the ones doing direct lending on occasion, providing many of the functions either directly or one step removed that banks used to. And of course, then the third piece is the growth of the fintech industry. And again, too much is being made. There's a lot of talk about disruption. I don't really see this as disruption. In my mind, in many ways, the world's regulators, the clients of the banking services, indeed, I would argue, I'm curious to see what Piyush thinks, the banks themselves are viewing this as both an opportunity to invest in, but also are happy to cede part of that space. They cannot afford to cover the clients that they used to. They don't have the balance sheet or the risk-weighted assets to dole out into many segments which need to be included not just from an inclusiveness standpoint, but segments which do represent profitability. So the growth of the fintech industry, which to me is a very profound phenomena, certainly in payments and direct lending. I think if we step forward 10 years from now, we will see a transformed industry in many ways. I think the development is a very welcome one because banks either choose not to or simply can't continue to be all things to all people. And in many ways, a mobile entrepreneurial organization which is taking advantage of the fact that millennials consume financial service products very differently than people certainly of my generation, allied with the fact that they don't have the onerous burdens of capital and the very high cost of regulation, and they can yoke the benefits of technology as well, I think does make for a very powerful combination of factors. So I'll finish by saying that I think this development in the financial services continuum is actually a welcome one. It does throw open some very interesting questions about regulation, about structure, and about exactly what the balance of division of labor ought to be today versus the future. But I would say we have a more complete financial services continuum today than we did 8 years ago.
Thank you very much, Anshu. Piyush, do you want to give your thoughts, and then perhaps we can have a dialogue between us? Do you agree, for example, with the points?
Well, I agree in part. So actually 3 points. But let me first start with Anshu's comment on he doesn't see this as a disruption, and I would agree with that. I think the word I prefer to use is transformation. I think our industry is going to be transformed substantially and quite fundamentally. It might not even be a decade. It might be just 5 years. And that transformation is being driven by some very profound changes in technology. Anshu alluded to a few. Let me just spell them out. I think the smartphone is a game changer, not just because you're carrying a supercomputer in your hands, but because it now makes location and context extremely relevant in a way that never used to be before. In the past, banking was an independent activity. Finance, you went to a bank, you even went to an ATM, or you went to your PC. Today, it goes with you in your pocket. And since it goes with you, you can finally make true something Bill Gates said 26 years ago. The world doesn't need banks, it needs banking, which means you can make the bank invisible. So to me, the future, one big change is that banking can become completely integrated into things people do with their lives. So to that extent, Anshu says it's a more complete system. There are a lot of people who can do a bunch of different things. I think that speaks to the point. You can actually integrate into a lot of other capabilities provided by quote-unquote fintechs. The second big change is big data. The volume, veracity, variety of data available today is mind-boggling. Banks have always dealt with huge amounts of data in our credit card businesses. In today's day and age, what I know about you is truly mind-boggling. I know who you are, where you live, all that stuff, but I know when you're in your room, I know when you turn on your television, I know which program you're watching, I know where you went to eat yesterday, I know where you're going to eat today. I know before you do which restaurant you're likely to go to in the next week. It's, now when you mirror that with deep learning, machine learning, and artificial intelligence, that becomes even more powerful. In our own bank, and it was interesting to me the previous discussion when I made this passionate plea that maybe technology should not result in reduction of jobs. That would be a very good and laudable objective. The reality is that train has left the station. And so today, for the sake of customer experience, for the sake of customer journeys, for the sake of productivity, you're finding that computers can do things which human beings used to do at a fraction of the cost, 10 times faster, and 4 times more accurately. That's a profound change. It's going to change the nature of our business. You don't need wealth managers because the robot advisors can provide that information much better than human beings can, and so on and so forth. The sharing economy, including companies like SoFi, but the notion that in a connected world, the idea of who's the producer, who's the consumer, or the creation of prosumers, and therefore the notion of being able to create shared participation in the means of finance becomes very important. In some ways, this is not a new idea. The creation of capital markets 30 years ago, or the disintermediation of banks, was fundamentally that idea you can go direct to market. Except you typically went direct to market to institutional investors. What the technology lets you do is go direct to market to large-scale consumer investors. And therefore, that can dramatically change the nature of finance as we know it. Cloud. And cloud is important because fundamentally it democratizes technology. So anybody can put stuff together. And I want to say finally, blockchain. To me, blockchain is potentially a game changer. I think the whole notion of value as we know it in societies today has been predicated on a hub and spoke arrangement. We all recognize value. You know how much money you have because the bank keeps track of it. Banks know how much they have because the central bank keeps track of it. We know whether you own your house because the Register of Society keeps track of who owns which house. In a distributed ledger and a blockchain technology, anybody and everybody keeps track of everything. So then you start wondering, why do you need a stock exchange? What's the role of a bank? What's the role of any other hub and arrangement and a hub and spoke arrangement? It could completely dramatically revolutionize the nature of the financial architecture of our systems. So I think that nature of changes is very, very profound, very compelling, and totally transformative. I don't think we'll recognize financial services as we know it in 10 years from now. Where I disagree with Anshu, I guess he asked me, maybe Piyush will agree or not, I don't, which is the notion that it's appropriate for banks to seed up a lot of this business because there are better other people who could do it better than banks could. While that's true, there are large parts of the value chain which are being disintermediated by a lot of efficient players. My own view is that there is no reason to believe that banks or singular large players will not be able to actually transform and bring effective end consumption activity. I'll give you an example which is actually not a bank, interestingly. And frankly, the people who I think are going to be most effective. It is what I think of as a platform company, and my example is Alibaba. What Alibaba has been able to achieve in the last 2 years, 3 years, both with Alipay and through Alibaba itself, is mind-boggling. So finally, what do banks do? Banks raise money. Alibaba, through Yourbao, raised $100 billion in 1 year. It took my company, DBS Bank, 50 years to raise $100 billion. 1 year. 0 branches, 0 physical infrastructure, $100 billion. Banks put money to work, they lend money. So Alibaba has got a credit bureau they've created called Sesame. On Sesame, they have now credit rated 38 million SMEs and 300 million individuals, closed loop credit bureau. They are today giving out loans, micro loans, SME loans, and individual loans faster than any other company in percentage terms, at lower delinquency rates and lower default rates than anybody that I know. What else do banks do? Banks move money around. Alibaba is the largest payment company in the world today, by a mile. They do hundreds of millions of transactions in a minute. Their gross merchandise value of traded stuff is far more than any company that you know. But it is one company. Alibaba today has the capacity to distort and displace existing banking mechanisms, but it doesn't have to be done by multiple fintechs who participate in the value chain. I think singular companies can do that. Exactly like Alibaba, I think large banks have the capacity to do that, to make the transformation. And in fact, in some ways, I think incumbents have some critical advantages. There is, for one, still the advantage of trust. You spoke about it, Jain, in the morning, saying, trust is eroded. I would argue that if you go and find out how many people today are willing to put $1 million in PayPal or Alibaba or Facebook, you'll get a very small response. Most people still believe banks are the place to keep serious money. And the reason for that to me is people still trust the institution. They might not trust the employees and the people, but they still trust the institution. Partly it is the notion of insurance protection, regulated, FDIC, and so on and so forth. A second reason I think banks still have a compelling role to play is participation in clearing and settlement systems. Today, whether it's Apple Pay or whether it's Alipay, they all tie up with banks at the back end to clear and settle. That might not last forever, and banks might wind up being dumb pipes like the telcos wound up being, but certainly in the foreseeable future, that participation in clearing and settlement mechanisms is quite important. Even in the realm of virtual currencies, and maybe we can talk about that, I think that's an important and inherent strength. A third is risk management. I think a lot of, in the credit space, a lot of people are exploring new forms of credit underwriting. Some well, some less so. You've seen what's happening to Lending Club in recent times. But across the spectrum of risk, particularly liquidity risk, gapping risks, marketplace risk, banks have developed both a DNA and capability, which is actually quite helpful. So it just seems to me that long term, there is still a relevant role for incumbent and large integrated players in this world of finance. So that is my comment on that. I had two other comments to make, and maybe I'll make them briefly, and maybe we come back to that. My second comment was really around India. We chose to launch our first mobile-only bank in India 2 months ago. It's architected around natural language, artificial intelligence, deep security, only mobile, etc. We chose to do it in India for an important reason, and I think it's worth reflecting on. Of all the countries that, certainly in which we operate, but I think from my knowledge, almost any country in the world, India has put together a public architecture for digital activity, digitization, which is immensely powerful and unique. My friend Nandan likes to call it the Indian stack or India stack. This India stack, which is the Aadhaar, the eKYC, a digital locker, a UPI unified payment interface, and now which is going to be developed with data consent architecture, I think is very powerful. What's unique about it is, unlike the US and China, which are two big countries in the digital domain, where some elements of this architecture are in private hands, India has chosen to put it in public hands. And I think this is very, very prescient. I think this digital architecture, it is going to be the highways of our future. There's going to be the toll roads, the ports, and this infrastructure, keeping it in public hands, I think is quite important, quite smart. The question this begs, of course, is should this even be national infrastructure or should it be transnational infrastructure? It's worth thinking about. The third comment I wanted to make was really around, as a good segue from this. I think one of the big challenges we have as society and mankind in the next 10 years is to think through institutional, legal, regulatory arrangements for this new world of digital finance. In fact, I would argue even social norms and social engagements. You take data privacy, and the norms and rules for data privacy have not even begun to be explored. In this world, data is omnipresent, is ubiquitous, but who owns the data? You go to an airport, a camera is taking a photograph of you. Is that your data? Does it belong to the airport? Does it belong to the security company? Does it belong to the airline? Could you go and ask somebody to remove your picture from that data? Is data good? Is data bad? Is cross-border use of data relevant, appropriate? I think there will have to be a global agency, frankly, to think through this almost as we're talking about an agency around labor. I think data security, the same issues and same global norms for how to deal with data security and how to get your hands around data security is something that will have to be considered. Blockchain. I said blockchain can be a game changer, but for blockchain to be a game changer, you need to build a network and you need to build protocols which are globally acceptable. As a banker, I have been, for the last 30 years, I know SWIFT have been struggling with getting common protocols for things like Bolero, for global trade patterns. It's not easy to do. I think we will have to define what kind of protocols will work for things like blockchain. And finally, as you move to the realm of things like virtual currency, there's some very serious issues. Virtual currency is obviously not new. Virtual currency, as in private money, has existed for a long time. It has both economic and historical precedents. But if we as society are going to start evolving to a regime where virtual currency, an acceptable mode, unit of account, or medium of exchange, it requires a lot of work and a lot of thinking and a lot of engagement across nation states and boundaries for this to happen. So we have a lot of work ahead of us, Jain.
Thank you very much, Piyush. I think just listening to you both, if I can try and sum up where our appetite is for this subject. If I hear you, Anshu, you're very, you say bring it on, really. This is a good thing. And I think, Piyush, you're saying there's no holding it back. So whichever way you look at it, it's going to happen. We just have to think about how we do infrastructure and architecture to try and make it sensible, safe, something that people can use. I'd just like to ask you some questions about that, because I think when we look, I think you, Anshu, talked about negative interest rates and the whole question of risk-taking in order to actually make money out of that. Where do you see this going? I mean, if in fact we have one part of the world, this part of the world, where we have positive interest rates, getting back to our earlier capital flows discussion, are we going to see all of the world's capital moving to China and India, and frankly, Europe and other parts of the world with negative interest rates going into a complete sort of Japanese stagnation for a decade or so? That's a pretty interesting sort of...
I don't think anyone knows the answer to that question, Jain. There is a fierce debate which is starting to rage, particularly in Europe, but not just in Europe. So all I can do is maybe frame my thoughts on it and give you sort of some early indications that are out there. But the first thing which I would say is that this is a very significant phenomenon, one which, by the way, was at the heart of the speed of the financial recovery that took place. So before I point out the negatives, let me begin by acknowledging that the US economy turns on its private ownership of real estate. You're not going to get consumer spending unless you can floor the value of people's homes. And of course, they'd been in a free fall post the crisis, which was beginning to threaten the health of banks, which still held the mortgages. It was holding off consumer spending. There was a vicious cycle in place. And there is no doubt in my mind that the central bank's intervention, which was multi-pronged, but the specific one which took rates way down, made mortgages cheaper, first stabilized and then turned Case-Shiller, which is the US residential pricing index, back up. And many of us in the industry felt that nothing was going to change unless Case-Shiller at least bottomed. Right. And so the role which low interest rates played there was profound. The second intervention, which to me was perhaps even more dramatic but less sort of noticed, in some quadrants anyway, was the intervention in Europe. Summer 2011, June 2011, Italy, which had at the time over 2 trillion euros of external public debt, the market was pricing at a 46% probability of implied default. Almost a 50-50 chance that the sovereign of Italy will not be repaying its debt, according to markets, which of course would have been multiple times bigger than anything which we saw in 2008. And there's no doubt in my mind that the ECB intervention made a massive difference. That famous Mario Draghi line, "I'll do whatever it takes," to stop it. And of course, whatever it took was a very rapid lowering of interest rates. The point I'm making, and I think it is vital to the discussion we're having, is that that was 2009 in the US and then 2011 in Europe. It's now 2016, and we're still sitting here with very low rates, synchronized across Japan, Europe, the UK, and the US. So pretty much the entire developed economy base is sitting there with policy rates either zero or negative. We've had profound societal impact from this. We've created big swaths of winners. If you own financial assets, you're looking good. If you're a saver, you're pretty miserable. If you're a deposit-taking bank, it's not a good development. If you're a corporation looking to refinance your debt, it's a very good thing. Yet we have not seen definitive work done which tells us what the cost-benefit analysis of this entire experiment has been. More importantly, where's it going to go? So, do I know the answer to where it will go? I don't think anyone does. I will say this. I would certainly alert, and I would join many people in alerting the fundamental dislocation which has taken place. So if you think about the way capitalism works, we put prices on things. When a price is high, resources move in. When you artificially set policy rates for this long at such low levels, the price of risk is distorted. My biggest concern, and I think in many ways virtual finance is a direct result of the negative interest rate, low interest rate policy, or at least the rapid proliferation of parts of virtual finance is because of that. Those distortions for a short period of time are one thing. This has been going on for a very long period of time. The quantums are enormous. The societal, political impacts can be significant. I don't think I have the ability to tell you whether the whole thing is good or bad at this point. All I will do, which is relevant to this discussion, is point to the huge distortions of capital flows, market pricing, and frankly, institutional behavior, which has taken place because of negative interest rates.
Piyush, you have
Well, I just want to supplement what Anshu said. To me, the real issue is, even if there is secular stagnation, the Larry Summers argument, secular stagnation need to keep low for long. The reality is that the low interest rates have stopped serving their purpose. The marginal incremental benefit you're getting from keeping rates low, and frankly even negative, is getting close to zero. So even if you figure that is the illness, this is not the medicine, because it's not actually working. In fact, ironically, you reach a stage where negative interest rates are doing exactly opposite what economic theory would suggest. Economic theory would say if you had low rates, you should have more consumption and investment. Today, the negative interest rates is creating a crisis of confidence. So people are basically holding back instead of coming forth. And that actually turns out to be doing exactly the wrong thing.
Thank you. I think that's very, very profound and interesting answer to my question. Mainly, we don't know, but nevertheless, very interesting.
Very well thought through, I don't know.
That's right. I'm very well talked through, I don't know. I just noted that both of you said that you don't see the development of virtual finance as a disruption. And I thought we might just explore that a little. When I was doing some reading on this prior to this meeting, I was fascinated that the People's Bank of China and the Bank of England are developing their own Bitcoin avatar to be actually disrupting Mr. Nakamura's dark web, Silk Road sort of in the hoodie sort of thing. The man in the hoodie is being replaced by the person in the smart suit. Now, I just want to know, who is the disruptor and who is the disrupted in this? And do you have a view on that? Or is this nothing to do with disruption? I'd just like to explore it a bit further.
I'm going to pick up on something Piyush said in his opening set of comments, because I think that's pretty profound. Having been part of a traditional bank for a very long period of time and now advising a couple of, in one case, a fintech startup, in another case, a fintech which is pretty well established, banks have some critical advantages. I mean, there's zero debate. That deposit base which a bank has is a game-ending advantage. So there is no, I mean, if it was a tennis match, it's 6-0, 6-0, 6-0. It's what I always tell some of the more exuberant participants in the fintech industry. So absolutely, the fact that, and by the way, negative interest rates really play into that, you literally are getting your money for nothing. If you're a fintech company, particularly in lending space, your cost of funds are going to be multiples above where a bank is. I think that's absolutely vital, and that is not going to change. It's by design. To me, the shape of regulation, which is in the end a fundamental driver. So regulation and monetary policy are really informing the shape of the financial services industry. Always have, but particularly right now. And in my mind, it turns on one very simple insight. Post-2008, I guess all along, but especially post-2008, the world has been cleaved into those that take deposits and those that don't. If you want to take deposits, there is a long checklist of things that you have to be. And that brings with it a cost, it brings with it a structural definition, it brings with it very rigid regulatory oversight, but it gives you very stable long-term funding at very low, indeed, sometimes zero cost of capital. And that to me is an overarching advantage which banks will enjoy. Hence my point that I don't see this really as a disruption. So there is an ecosystem where if deposit rates are what drive activity, so low-cost lending, for example, no one other than banks can fund the top-rated blue-chip corporates of the world, or indeed the very high-rated AA or single A or higher borrowers. My simple point is, where fintech companies, where private equity and hedge funds are playing a role is in completing that continuum and occupying the space, which from a regulatory design standpoint, I'm not sure banks are even intended to by the regulators that are watching over them. If I just look at the implied cost of doing business, a mobile, low-cost, less deeply regulated private player will have certain advantages, but the big disadvantage of not having a funding base.
Could I just perhaps explore that just a bit further, and I'll come to you, Piyush, on this. But so Alibaba, for example, it's a big conglomerate that has a financial arm. I understand it's now doing some lending. Is it a bank? Should it be regulated as a bank? Will it be regulated as a bank? Maybe I should ask Piyush this question. Where is the line between what is a bank and what isn't a bank, and is it blurred? Are the regulators?
I think it is a blurred line, to be sure. I think this whole notion of what is a deposit, and therefore if a deposit-taking institution should be regulated, is also extremely blurred. In today's day and age, as people go more and more into direct participation, we take money market funds. Right? So tons of people put money into money market funds, and you can argue does not have the imprimatur of the Federal Reserve, therefore doesn't have deposit insurance, and is buyer beware. But the reality is, if you think about consumer knowledge bases and consumer expectations, the expectations tend to be quite different. In China, there's today $5 trillion of money in their shadow banking system. Entrusted loans, trust loans, wealth management products, structured products, etc. The bulk of this is coming from individuals. And these individuals are putting money into all of these products, believe me, with zero expectation that they will not be bailed out. So they see no distinction in their minds about putting the money in a bank deposit or putting the money in any one of these other products. And guess what? The first time there was a challenge with one of these intermediaries, the central bank and the government leaned on the banks to take those intermediaries and make them whole. So you have to start wondering, where do you draw the distinction between is this a bank or is this not a bank? P2P lending in China. There are 4,000 P2P companies that got created in 3 years. In the last 6 months, 3,000 of them have been shut down. The reason for that is since the beginning of the year, there have been flameouts of P2P companies. Izubao raised money from 900,000 people, $7.4 billion. It was a Ponzi scheme. The $7.4 billion went into companies which were make-believe. The 900,000 people who put their money into Izubao still are standing there on the streets demonstrating because they say, hey, we expect to get the same protection as a depositor would. So we have to think as the world evolves, this distinction will be very hard for central banks and very hard for governments to make stick. So it's a question mark. I was telling Jain outside before we walked in, I met the regulators in Shanghai some months ago. And I told them, for me, if it walks like a duck and it talks like a duck, then it's a bank. And so I said, by the logic, why don't you regulate Alibaba? They do everything a bank does. And he sort of smiled at me, and in a unusually humorous way, he said, well, the answer is quite simple. Earlier they were too small, now they're too big.
Just one other question. I think we discussed the issue of social norms, particularly in the use of big data, the way in which there'll be, I guess, and I'm perhaps putting words into your mouth now, but the way in which there's almost a convergence of technology, banking, the separation between what you do on your iPhone is becoming less and less. I buy things on my iPhone. I use a payment system which links eventually to a bank. I noticed that Goldman Sachs, by the way, is looking has now patented something which doesn't need a credit card at the other end of it, which we'll see where that goes. But if you take that all together and you see the Jain Diplock that is on my iPhone and you can then mine it for information, is this a role that a bank would want to do? Is it a role that you would see? And is this a distinction between the banking and non-banking framework, or is it a mirage?
To me, that's a mirage. I cannot imagine any customer-facing company which is not going to have to become expert at this. So if you're selling music, if you're selling clothes, if you're booking, I love Piyush's line, we know where you're going to eat next week, even though you may not, because statistically, big data doesn't lie. So to me, the difference is this. The distribution model for entirely too long has been an undifferentiated model, right? So you walk into a store, there's small, medium, large, and there's 4 colors, and that's where you have to choose. And if you don't like that, too bad. So really what I think is now possible is customization of a level which we actually cannot even begin to conceive of. And yet in the past, I used to hate customization as a provider of services because to me that meant expense, right? A good retail operation was one which would really try and make everything as uniform as it possibly could. What I think big data really allows you, a combination of big data, smartphones, frankly, user demographics. Millennials consume products very differently. The way they read the FT, the way they read entertainment, the way they watch television. It's no longer 8 o'clock is prime time, that's when we'll watch Game of Thrones. No, it's Wednesday, I have an hour, I will go back and retrieve the box set and I'll watch 9 of those in a go. I think banking services are going to be are in the process of being transformed, but they'll be no different. To me, they'll be much safer because that unique identifier is going to make identity theft that much harder. We will be sharing frightening amounts of information back and forth, which I think there is some privacy issues around that. There are some data issues around that. Piyush touched on that already. But to me, I cannot imagine anyone sitting out this round of big data customization. So it's not just banking. I think every industry in the world that faces consumers has to have a strategy.
I agree entirely, totally. And I've got this theory on data. I think the use of data is, and the rules and norms around which data is used, can a bank use, a bank should be doing that or shouldn't be doing that, is going to transform, or thinking around that is going to transform very considerably. And the analogy I use is the regulating of a gun versus regulating of a knife. So when you regulate a gun, you do it through a registration process, except in the US where you give it out with candy or something, but everywhere else. And so I call this essentially how data is controlled today. It's a notice and consent regime. You have to say, I accept every time you click something on this thing. Every time the camera, there's got to be a little thing over there saying you are under surveillance. So the whole regime is a notice and control regime, much like guns are controlled. You register and control. But knives aren't controlled like that. You can't control a knife like that. A knife you can buy freely, but if I use the knife to cut my food or fruit, it's okay. If I use my knife to stick it into you, Jain, it's not okay. I'll be thrown into jail.
Okay.
A knife is controlled by context and use. I think the evolution of society is going to get to a level where data use has to be controlled by context and use. because it'll be so ubiquitous. When my shoe, my shirt, my washing machine, my car, everything's generating data. How do you control it? So you have to get to a state, why was data intended? What was the intent of this data? What is the provenance of this data? And has it been used appropriately? And in that context, you will find, exactly Anshu said, that millennials' view of what is appropriate use of data is very, very different from our generation. For them, it's a great deal. If you can use the data and give me a better deal, a better price product, a more suitable product at my time, at my convenience, be my guest. So I think the way the world is evolving, everybody will be using data. And all you'll have to do is make sure, like a knife, you don't use it to go around murdering people.
On that delicious note, I just have one rather inappropriate question I'm going to ask you both. Does this mean that banking has to become sexier? I mean, that the banks have to somehow remodel themselves to look more like a fintech?
Like Anshu.
Or are you going to still remain, if you like, relying on your sort of conservative, solid image as part of your advantage? How do you think that will play out over time?
So in my very short-term experience of working in the fintech sector, which is really now only a few months, the biggest thing which struck me, I expected to walk in and be blinded by science, and that may still happen. Don't want to take anything away from the companies I'm working with. But what really struck me was that the difference wasn't in the technology. It wasn't in, I mean, banks are very entrepreneurial. Some of the banks which I know are just as entrepreneurial as fintech companies. I agree with Piyush on all of that. I wouldn't think banks would cede any of that. What struck me as different was that the value proposition that they were presenting to clients was completely different. So the way they define the company I'm working with, their target audience, they call them Henrys, high earning, not rich yet. Okay. They hand out t-shirts. There's a very strong affiliation. They have social events where people that have been adopted, that are almost members of the SoFi Club, are invited in to participate in social events. All sorts of things which I couldn't imagine a bank doing. So, not that it couldn't. I think for the longest time, and I think it does make sense, banks present a fortress-like, and that's a word which is used by many a bank CEO, fortress balance sheet, strength, solidity, so on and so forth. And I do feel that aspects of virtual finance are playing on the rapidly evolving, dynamic, cool, trendy image. Yeah.
Piyush?
Well, I agree. And I think banks which survive will have to be sexy.
On that sexy note, we're now ready for questions.
Thank you. The first question comes from Rohinton Medora, who wants to go back to the issue around blockchain and ask, is blockchain a winner-takes-all game? And if it is, what does this imply about systemic stability?
I don't think so at all. I think blockchain is just a more clever database. And it's a database which is an integrated, multi-party, multi-use global database where everybody has access to it. Everybody has read and write rights, and everybody can keep it updated with all the appropriate authentication, security, etc., etc. So it essentially becomes a broad global protocol for exchange of information, value, etc. It's certainly not owned by any one person, which is why I don't see it as a winner-takes-all arrangement.
Okay. Linked to that, the discussion around virtual finance, and particularly around cryptocurrencies, Bitcoin, the like, where is the tipping point for when these types of items become more quotidian reality? Is it at the point of a crisis, or is it at a point earlier than that through, or hopefully earlier than that, through common usage? You talked about a 5-year time frame. What do you think?
So I think let me broaden that by talking about the history of financial innovation. Piyush talked about the approach to regulation of a large entity in China. I think that's true, by the way, for most of the very innovative financial products that have come along. And here I'm thinking about derivatives, securitization techniques, CDO techniques, and to me, certainly Bitcoin joins that continuum where financial thinkers, innovators, users, providers are running very rapidly And regulators and controllers, by the way, within the institutions as well, are a step behind. And so very often, because of that, it takes something bad happening to then get very serious questions being asked. In the case of securitization and derivatives, it was a case of risk retention. Is it okay to be originating vast amounts of synthetic securities and on selling them without keeping any skin in the game? Very fundamental point, should have been thought about all along. The rating agency requirements to confer very high ratings on some of these products. So to me, I think there is a reality that very often it takes a minor accident to get a rapid change in regulation, and hopefully we've learned from the events of the last few years, and this time we can anticipate. And it's a theme which has been running between Piyush and I, which is, I think we both welcome what's happening, but we do feel that a regulatory framework is needed.
I think the blockchain is a very powerful technology. I think distributed ledgers have tremendous capacity. I think virtual currency is going to be the hardest use case to put on the distributed ledger. If you think about what makes money money, and you think about the three elements of it: unit of account, medium of exchange, store of value. Today, even where bitcoins or other forms of virtual currency are being used, nobody really uses it as a unit of account. The unit of account still goes back to fiat money. It is being used as a medium of exchange, but in very, very limited ways in closed loop systems. For it to become a true medium of exchange, it's got to continue to have a lot of convertibility to fiat money. And I don't see that changing in a long period of time. And finally, the store of value. If you don't have enough liquidity, the value considerations in it keep moving up. You move from $1,200 to $200, not because of the intrinsic nature of the store, but because there's just inadequate supply. So left to itself, I don't see virtual currency becoming a dominant form of money anytime soon. But with one caveat, and that now goes back to the question you asked earlier, Jain. I think the quickest and best way to make virtual currency real is for it to be fiat money. And therefore, as soon as virtual currency begins to get the backing and the imprimatur of a central bank, that virtual currency will start becoming to get accepted in society by people and so on and so forth. Therefore, Bank of England's, the RF this thing, People Bank of China, in Singapore, many central banks are today actively exploring the idea of issuing digital money. Now you can argue, is that virtual currency, is that e-money, that's not a moot point. I mean, to me, the real issue is the minute you can issue, a central bank issues fiat money in digital form, it'll start getting accepted and traded. By the way, private money, which is not issued by central banks, also has a history. For long periods of time, the central money was not legal tender. And even before it was legal tender, it was not monopoly money. Individual banks issued money. In France, the central bank got monopoly tender 40 years after it became the central bank, and became legal tender even 40 years later. Even in the US, it became legal tender only in 1933, way after it started getting issued as legal money. So there's history for private money. But I think it's quite clear that where the world is evolved today, I think there is a lot of risk with private money. And the risk with private money comes not just from financial system stability. I think the ability to control inflation becomes a challenge. Lender of last resort issues become a challenge. Fundamentally, monetary policy control becomes a challenge. And as a consequence, I think nation states will be very loath to give up the monopoly issuance of fiat money to private parties. I think it will stay in central hands. But I think the quickest way for it to become real usable money is for it to become legal tender fiat money issued by the central bank.
Thank you. There's a cluster of questions now related to the first theme below for virtual finance, namely inclusiveness, and related specifically also to India. So the questions are, what are the India-specific challenges for fintech firms? And can this type of product be used for financial inclusion in India? And one particular comment by Ambassador Suri here is taking into account, for example, the low levels of literacy. How soon can we get into the game here?
So it's a topic which I've been thinking a bit about recently. We're trying to do something in that space. And certainly I would say, and again, I'll pick up on what Piyush said, I think the achievements of Nandan Nilekani and his team were fundamental in now aligning 3 or 4 different trends together. The gap between credit supply and credit appetite in India is very significant. Last I checked, the total supply of credit in India as a percentage of GDP was about 60%. That, in other Southeast Asian countries, averages almost double that. So in simple terms, there isn't nearly the same credit extension happening in the Indian economy as you see in some of the other countries. That's well recognized by authorities. Those issues are being addressed. But I don't see bank balance sheets being able to grow as rapidly as they need to be able to overcome that gap. So to me, I think a wholesale funded NBFC approach generally, so this is not just fintech, I think is a very important part of the ecosystem, back to the point we were making earlier. I think a lot of the new adherents and a lot of the people that will be using smartphones in the future don't actually need to go through the same education, very long lead time that it took to adopt clients into the financial system. I think we can leapfrog all of that. Between Aadhaar on the one side, smartphones being priced between $20 and $30 million, new connectivity companies being launched, 4G about to become ubiquitous, some would say, I think the preconditions are in place. And certainly, in my opinion, financial inclusion is a critical priority in India. And I think NBFCs in general, fintech companies in particular, and of course, by the way, banks will play an absolutely critical role here as well. I just think there are things that can be done very rapidly with fintech getting it right.
So there are three elements to financial inclusion traditionally. One is the ability to save your money, so the deposit gathering approach. I think M-Pesa in all over East Africa has demonstrated that people are willing to use low-end telephones to actually save money. I think the Jan Dhan Yojana, which is 200 million accounts, a lot of it is owes itself to the last mile, which you do also with an agent going with the phone. So I think the ability to create savings capacity can be tremendously benefited by fintech. The second thing, you talk about financial inclusion, the ability to pay. Again, M-Pesa has a great case in point. All of payments go off the phone. I think between that and the UPI, I think UPI is a game changer for India. I think UPI is going to make a dramatic difference to the ability of people to be able to pay money from the remotest parts of the country to the remotest part of the country. So I think payment is going to be impacted. And finally, perhaps most compellingly, it tends to be about the ability to get credit formation. I think one of the things we haven't talked about, but credit underwriting becomes extremely different if you can use data and data algorithms that you did not have access to before. I think the ability to provide rural credit in India will change dramatically with data around monsoon, crop patterns, productivity, etc. So I think in financial inclusion will be benefited massively by this whole wave of fintech.
Well, thank you very much, both of you. Please join me in thanking Anshu, Jain, and Piyush Gupta.